If everyone withdrew their money tomorrow, banks would collapse in 48 hours. And it's completely legal. Right now, your $10,000 in the bank. Only $300 of it actually exists. The rest is a number on a screen, backed by a promise created in 1913. This is called fractional reserve banking. When you deposit $1,000, the bank keeps maybe $100 and loans out $900. That $900 gets deposited somewhere else. And that bank loans out $810. Your original $1,000 just became $2,710 in the system. But here's the problem. If you and everyone else want your money back at the same time, the bank has to tell you no, because it doesn't exist anymore. In 2008, this almost happened. Lines formed outside banks. The government had to step in with $700 billion to stop the panic. But what they didn't tell you is this. They removed the reserve requirement completely in 2020. Banks now keep 0% of your deposits. So here's the real question. What's stopping it from happening again? You wake up tomorrow morning, check your phone, your bank balance, $0. Not because you were hacked, not because of fraud, but because 10,000 other people in your city decided to withdraw their money yesterday, and the bank ran out. You call customer service. 40-minute hold. When someone finally answers, they say, "We're experiencing technical difficulties. Your funds are safe, but withdrawals are temporarily suspended." Here's what they're not telling you. Your bank doesn't have your money. It never did. The entire banking system runs on a simple bet that you owe and ask for it all at once. Let me show you exactly how fragile this system is. When you deposit $10,000, you think it sits in a vault with your name on it, but the moment that money enters the bank, it's no longer yours in any physical sense. The bank takes $10,000 in cash and turns it into something called excess reserves. Reserves are what banks keep on hand to process withdrawals. Before 2020, they were required to keep 10% of deposits. So your $10,000 became $1,000 in reserves and $9,000 in loans. But in March 2020, during the pandemic, the Federal Reserve quietly removed that requirement. Reserve ratio, 0%. 0. That means your $10,000. The bank can loan out all $10,000, keep nothing. Your balance still says $10,000, but that's just an IOU, a promise, backed by loans to strangers buying houses and cars. And this isn't illegal, it's the design. Now let's scale this. You deposit $10,000, Bank A loans $10,000 to someone buying a car, that person's payment goes to the dealership. Dealership deposits $10,000 into Bank B. Bank B now loans out $10,000 to someone buying a house. That money goes to the seller, who deposits it in Bank C. Your original $10,000 has now created $30,000 in the system. Economists call this the money multiplier. It's why the economy grows. It's why loans exist. But it's also why everything can collapse in days. Because every single dollar in that chain is the same dollar. It's claimed by 3 different people, but it only exists once. The system works as long as no one asks for proof. Now imagine this. A rumor spreads, Bank A is unstable. Doesn't matter if it's true. 500 people show up to withdraw their money. Bank A has $10 million in deposits, but only $500,000 in actual cash. They run out by noon. News spreads now. People line up at Bank B, then Bank C. This is called contagion. One bank's failure becomes everyone's panic. And once it starts, it's almost impossible to stop. This has happened before. The Great Depression, 1929 to 1933, 9,000 banks failed. People lost everything. Lines wrapped around city blocks. Families showed up with suitcases, begging for their savings. Most walked away with nothing. The government's solution? Create the FDIC, the Federal Deposit Insurance Corporation. They insure deposits up to $250,000. If your bank fails, the government pays you back. This stopped the panics. People trusted the system again. But here's the catch. The FDIC has $128 billion in reserves. Total insured deposits in the U.S.? Over $10 trillion. That's 1.28% coverage. If even 2% of banks failed simultaneously, the FDIC couldn't cover it. They'd need a bailout. From taxpayers, from you. 2008 proved this. Bear Stearns collapsed. Then Lehman Brothers. Suddenly, no one trusted anyone. Banks stopped lending to each other. The entire system froze. The government stepped in with $700 billion in bailouts. They called it the Troubled Asset Relief Program TARP. They bought toxic assets, pumped liquidity into the system, stopped the panic, but it was close. Weeks away from ATMs going dark. And it almost happened again in 2023. Silicon Valley Bank collapsed in 48 hours. $42 billion withdrawn in one day. The 16th largest bank in America, then Signature Bank, then First Republic. The government stepped in again. Guaranteed all deposits, even above $250,000. Stopped the contagion. But each time this happens, the bailout gets bigger, the trust gets thinner. So let's run the simulation. What happens if everyone tries to withdraw their money? Day 1. A viral post claims banks are failing. 50 million people check their accounts. 10 million try to withdraw. Most banks have 3 to 5% of deposits in cash. They run out by midday. ATMs go empty. Bank branches close temporarily. News channels show lines. Panic spreads. Day 2. The Federal Reserve issues a statement. The banking system is sound. No one believes them. 100 million people try to withdraw. Online banking crashes. Branches stay closed. The FDIC announces they're processing claims, but there's no cash to distribute. Day 3. The stock market crashes. Banks freeze accounts for security reasons. Credit cards stop working. Payroll systems fail. Grocery stores move to cash only, but no one has cash. The government announces a bank holiday, a temporary closure of all banks. It's supposed to last 3 days. Day 7. Banks are still closed. The government announces an emergency stimulus. They'll print money and deposit it directly into accounts. But without banks open, no one can access it. Protests start, then riots. Grocery stores are looted, gas stations run dry. Week 2, the military enforces curfews. The government negotiates with foreign countries for emergency loans. The dollar's value collapses internationally. By week 3, the system has fundamentally changed. Either the government nationalizes the banks, or we move to a new currency system entirely. This isn't fiction. This is the documented progression from every major bank run in history. Now here's the twist. This probably won't happen. Not because the system is safe, but because of psychology. Most people don't understand how banking works. They trust the numbers on the screen, and that trust is the system's strongest defense. But trust is fragile. 3 things could break it. 1. A cyber attack that freezes banking systems for weeks. 2. A cascading bank failure larger than 2023. 3. A loss of faith in the currency itself. Hyperinflation, debt crisis, or geopolitical collapse. And here's what makes it dangerous. The system is more fragile now than in 2008. Why? Banks hold more complex assets, derivatives, crypto exposure. Commercial real estate interest rates rose faster than any time in history 2002-2023. Destroying bond portfolios. Reserve requirements are zero. Global interconnection means a crisis in one country spreads in hours. The tools that stopped 2008 bailouts, quantitative easing, are harder to use now. Government debt is at record highs. Public trust in institutions is at record lows. So what's the answer? Central bank digital currencies, CBDCs. Governments are building them right now. China already has one. The US is testing one. A CBDC eliminates banks as middlemen. Your money sits directly with the Federal Reserve. No fractional reserves. No bank runs. But it also means the government controls every transaction. They can freeze your account, track your spending. It solves the bank run problem by creating a surveillance problem. So what do you do with this information? Don't panic. Bank runs are self-fulfilling prophecies. If no one panics, the system works. But be smart. 1. Diversify your deposits. Don't keep everything in one bank. Spread it across institutions. Keep it under $250,000 per bank for FDIC coverage. 2. Hold some cash. Not your life savings, but enough for 2 weeks of expenses. Keep it somewhere safe. 3. Understand your bank's health. Look up their capital ratio, their exposure to commercial real estate, their liquidity coverage ratio. This is public information. 4. Don't trust too big to fail. 2008 taught us that too big to fail just means taxpayers will pay. 5. Watch the signals. Bond yields, bank stock prices, FDIC closure lists. These show stress before the public panics. And most importantly, understand that your money isn't really yours. It's a claim on a system that only works because we all agree it works. That's not a conspiracy. It's just how modern banking functions. The question isn't whether the system is fragile. The question is whether we'll keep trusting it anyway. So here's the thing. They don't tell you in school. The entire global economy runs on a shared delusion. We believe numbers on screens are real. We believe banks are safe. We believe the government will always step in. And as long as we all believe it together, it's true. But the moment that belief cracks, the moment enough people ask for proof, the whole thing unravels in days. Your bank account isn't money, it's a promise. And promises can be broken. So ask yourself, how much do you trust the system? And more importantly, what happens when everyone else stops trusting it too? End screen. The next bank run won't be stopped by bailouts. It'll be stopped by the system you didn't agree to. Are you ready for what comes next?